All right, class. Good evening, everyone. You're welcome again to another class on corporate reporting. Today, we will be starting a new topic in the name of financial instrument. So, what do we have to cover under this topic, financial instrument? So basically, all we want to look at when it comes to financial instruments is all about debts and equity instruments. That is all we want to look at. And when we say debt, you have debt as an individual or as a corporate entity when you borrow money from another entity. And you would have equity when you collect money from people and those people automatically becomes your shareholders. Then what you have done is you have issued equity instrument. And you see, the combination of the two is financial instrument. And that is what we want to look at today. If you take banks, for example, they spend a lot of efforts, both administrative and even marketing effort. All they're trying to do is to raise debt, which they call customer deposits. The money you put into banks. You see, as far as the bank is concerned, it is debt to them. It is a liability to them. And it's so important to them. I mean, it's so funny. There was a day I was in a banking hall, and there was this guy that came in. The guy was, I don't know where he came from. He was just angry. He went to the cashier or to the teller, and the guy was like, "Hey, where's your fucking manager? I want to see your fucking manager." Ah. Then the cashier was like, then the teller was like, "Okay, which one is fucking manager? You don't have a fucking manager yet. What do you want?" The guy was angry. I said, "I want to see your fucking manager. You are telling me you don't like what? Where is your fucking manager?" Everybody was amazed that what is happening here. So I guess the manager had the noise because the security people got involved and they asked the guy to leave. So the guy was angry apparently, and the kind of tone he was using was not very corporate. So the manager actually came down and was like, "What is happening? That I'm the manager." And the guy was like, "You're the fucking manager." "Yes." "Okay." And these people asked me to go out and I'm going to go to another bank to go and deposit my fucking $1 million. When the bank manager had $1 million, the guy said, "I'm the fucking manager. Let's go to my fucking office upstairs." This sounds very funny, but it shows the importance of the topic we want to do today for the survival of a lot of entities. Without financial instruments, a lot of entities will not be surviving today. And we as corporate reporting students, our focus today, what you're going to learn at the end of this class, majorly, we are going to look at the classification of a financial instrument into liabilities and equity. So you're going to learn which financial instrument is a liability, which one gives rise to a liability, and which one gives rise to an equity. And also, we are going to learn a term called compound instrument, which you have had before. When we learned IFRS 2, we learned about where there is a settlement, where there is a choice of settlement, right? And in that scenario, we say this is a compound financial instrument. So we are going to be looking at something similar to that here as well, because there would be some financial instruments that would have elements of both liability and equity within them. So we need to find a way to present those kind of financial instruments as well. You see, we're going to learn this using IAS 32. And IAS 32 is about financial instruments present.
Not the head, the cord. The cord I have is
Okay, it has been muted. Then we are also going to look at how do you recognize financial instruments? How do you de-recognize financial instruments? How do you measure financial instruments? And how do you impair financial instruments? I will not be teaching you hedging in this class and derivatives. There are derivatives too. So it's, for me, I see it as outside the scope of your syllabus here. So I won't be touching on that. And recognition, derecognition, measurement, and impairment of financial instruments is covered in IFRS 9. So we are also going to look at IFRS 9. And also, there is IFRS 7, which looks at financial instrument disclosures. How do you disclose financial instrument generally? Again, I would say this is also outside the scope of our syllabus. Yeah. Even in diploma in IFR, it's not even within your syllabus as well. So you're supposed to go and read that when you qualify yourself. All right. So basically, our focus here is going to be on IAS 32 and IFRS 9. Now, you see, the objective of this standard, I've mentioned it indirectly. Majorly, we are going to learn the principles around presenting financial instruments, either as a liability or as equity. We are also going to learn the principles relating to offsetting financial assets and financial liabilities, if any. And also, you need to be able to draw a line of distinction between financial instruments I will be teaching you and subsidiary investments, associate investments, and joint venture investment. You need to draw a line of distinction between them, because subsidiary investment, I don't know if Mr. Kazim has started teaching you group accounts. You see, intercorporate investments also are true financial instruments. They are true issuance of shares. A parent invests in a subsidiary. But the level of investment now give that parent entity is positioned as a parent, because he now has either significant influence, which we now call that kind of financial instrument associate investment, or he has control the subsidiary investment, or there's, which is joint venture investment. This is outside the scope of what I want to teach you today. All I want to teach you today is what I'm sure he will have called simple investment, right? Where the holding in the shares you have bought is really less than maybe 20%, if you want to look at it numerically, but you don't have any form of influence of the company. As a result of this, you're holding. That is what we want to look at, or that is the focus of what we want to learn today. Every other one are IFRS 8, IAS 28, and IFRS 11, which Mr. Kazim is going to teach you. So what is a financial instrument? I've given you like an insight into it, and you already know now that summarily, the financial instrument is either debt or equity. And you can see the way a bank manager turned his office into a fucking office when he heard that a customer was bringing a financial instrument. That shows how important it is. So how did IAS 32? Because definitions of financial instrument and other terms are in IAS 32. So let me focus on IAS 32 now so that we can understand the entire component of financial instrument. So what is a financial instrument? It says that a financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. A contract that gives rise to financial asset of one entity and a financial liability or equity instrument of another entity. A financial instrument must be a contract. Before we can even call an arrangement a financial instrument, there has to be a contract. And when we say contract, don't picture it as something that has to be in writing. No, a contract need not be in writing. A contract is just an understanding. A contract is an agreement that is legally binding. An agreement that has clear economic consequences. That is a contract. Whenever you are into an arrangement and you have to do something, and you know if you don't do that thing, you will be penalized. You will have to be forced to do even more. Then you are into a contract. So for us to have a financial instrument arrangement, there has to be a contract. That's one. Now, this contract in question would give rise to financial asset of one entity and financial liability or equity instrument of another entity. Of course, when we call it a contract, there must be at least two entities here. Two entities. Now, these two entities, we are saying one entity must have a financial asset, and another entity would have either a financial liability or an equity instrument. Financial liability or an equity instrument. And that is it. That is a financial instrument. You see, all these components I've mentioned must be present before we can have a financial instrument. There must be a contract. There has to be at least two parties. One party must have a financial asset. The other party would have either a financial liability or equity instruments. I need you to understand this very well. If that exists, then we have a financial instrument. So in the next 10 or 15 minutes now, my focus is going to be giving you examples of transactions, and you are going to be telling me whether there is a financial instrument in place. And what I would need you to look at is there, okay, how many parties do we a minimum of to find? Does one party has financial assets? Yes, fine. Does another party has either financial liability or equity? Okay, either, yeah, fine. If all that are present, then we have a financial instrument arrangement. If anyone is missing, it is not a financial instrument. So before I give you or start asking you about those scenarios, so I think we need to understand deeply what a financial asset is, and also deeply what a financial liability or equity instrument is. Because more importantly is that since they say that the other party would have either financial liability or equity, that means it's extremely important that you understand the difference between financial liability or equity instrument. So before I move to explaining this to you, let me give you a shot. I mean, is there anybody in this class who can conveniently in a very simple way, not definition, in a very simple way, give us practical example of financial assets, financial liability, and an equity? I mean, use yourself as an example. When can you have a financial asset? When can you have a financial liability? When can you have an equity instrument? Is there anybody that can give you the shot in this class? Without wasting our time. Now, you see, for financial assets, this standard
Hello?
said that. Yes, I'm with you.
I was going to try.
Okay, please go ahead then.
So I think a financial asset is like any kind of asset that derives value from the claim or ownership of another, that something that presents economic value, like assets that include things like stock, bonds, bank deposits, cash. They are forms of financial assets. So, like for instance, now, or derivatives, like derivatives is like a financial contract whose value is derived from the value of an underlying asset. And same as stock, the shares of ownership in a company may provide dividend and potential gain from the company, basically. So like an underlying asset, sha.
Fantastic. How about financial liability? So what I've said about financial asset is when you invest, when you buy shares, stocks, bonds, like that. Okay. How about financial liability?
Is like a legal obligation, like when a company or an individual owes another party. So
I
examples
can give an
of
example with that if she's done.
financial liability,
Okay.
like loans, bonds payable, accounts payable, lease, like anything that any form of obligation that a company or individual is obligated to pay to another party
What about tax?
through.
What about tax to the government?
Yes.
Yes, it's a financial liability.
You know, when we
Like
did IFRS 2, share-based payments,
Yeah.
we considered two forms of financial instrument to an extent. The cash settled share-based payments and the equity settled share-based payments. So both of them are also financial instruments. For the cash, what we are talking about financial liability, and the equity refer to the equity instruments. So that is the example that quickly comes to mind. For the tax also applies. We have the liability, the deferred tax liability and deferred tax assets.
Interesting. Okay. One of you had that full and very basic explanation of financial asset, financial liability, and equity. So without even that basic explanation, I'm not saying that I mean, let's delve into it and see what more we can learn beyond that. But I'm going to keep it very basic because the definitions given in IAS 32 is quite elaborate, and a lot of it we would not even require. For financial asset now, it's three things. It's three things, right? And before I go into this definition, the first thing I need you to have in mind is every one of you in this class, if you have bought shares in any of these banks that are publicizing their shares right now, I mean, you have a financial asset. That is a financial asset. So financial asset is attributed to an investor. When you invest, you have a financial asset. But the investments we are talking about now, for it to be a financial asset at your level now, is just three investments. Number one is cash. Cash. So when you have money in the bank, when you have physical cash, when you have fixed deposits, it is an investment, right? To you, it is an investment. So cash is a financial asset. That's one. Two, equity instrument of another entity. So financial assets, like I've told you, is just investments. So is either in cash or in equity of another entity. So if for any reason you buy shares in any entity, you are an investor, you have a financial asset. So your type of investment is called a financial asset. That is an equity investment. So when you buy shares in another company, you have a financial asset, you have invested. Thirdly, is a contractual right to receive cash. A contractual right to receive cash. You can only have a right to receive cash when you have lent money to someone. When you have given your money to another party with the expectation of getting your money back at a fixed date. And of course, you will get interest. That is what can give you right to receive cash. Or probably, if it is not money you gave to that person, but maybe you gave that person goods or services. The key thing here is this: whatever you are giving to the other party, not necessarily cash, it could be goods, it could be services. But if there is a contract, and that contract gives you a right to receive cash, it is a financial asset. And in fact, you have invested. And that kind of investment is a debt investment. It's a debt investment because any investment that gives you right to receive cash is a debt investment, because that other party has an obligation to deliver cash. It must give you cash. Emphasis on cash. So, financial assets is an investment. There's nothing more than that. Only a person that has invested can have a financial asset. And what are you investing in? You know, there are a lot of things you can invest in. You can invest in real estate. You can invest in maybe assets. You can buy motor vehicles you want to be using for Uber. There are a lot of investments you can do, right? But the one that is a financial asset is three. Number one is keep your cash as it is, so that in a way that you can go to bank and be withdrawing it as you please, or you can tell the bank to help you keep it for 3 months. That's fixed deposit, right? Or 90 days or whatever. Cash is a financial asset. Number two, when you invest in shares of another entity, that is a financial asset. Number three, when you invest in debt, that is what will give you contractual right to receive cash. You see, this other one, yeah, this other definition, you can cram it. But as far as the application is concerned, it's beyond the scope here. We won't touch it. You won't even find it in any of your exams because they are the complex part of financial instrument that we will not really delve into that much. Like Bemi was mentioning derivatives the other. I'm not going to teach you derivatives here. Why would I stress myself teaching you that when you will not find it in the exam? But when you qualify, a lot of you can come back for diploma in IFRS exam, which will start next diet. If you qualify and you want to specialize in reporting, you want to know everything about reporting, then of course, do diploma in IFR. We'll teach you most of the things that we just overlook here, and you'll be a core expert in reporting. But for now, financial asset is either cash, investment in equity, investment in debt. So examples: trade receivables, lease receivables, equity instrument of another entity, cash. Yes, sorry, I think my internet just went off. Okay, so did you hear my question? Hello, class.
No,
Did you hear my question?
no, sir.
You were explaining the
Okay.
question, no. Yeah.
Okay. So let me take it again. I said that I want to ask you a question, just to be sure that you understood everything I've mentioned or explained about financial asset. I said that if I invest or buy a plant that I want to use to manufacture maybe slippers or sandals, so I can be selling and make money, can I classify that investment as a financial asset? If you want to talk, raise up your hand, then you talk. Can I classify that investment as a financial asset?
No.
No. Okay. Any other one?
I say no too.
Okay. All right. So why? Is it that it doesn't meet this definition or what? Can't that be a contractual right to receive cash? Is a question. Feel free to talk now. Let's just discuss. So can that be a contractual right to receive cash? So if you invest in plants and you want to use it to manufacture whatever, maybe slippers, so that you can sell and make money. So we said, all of you said it should not be a financial asset because there is no one that said yes here. So that means you all agree to no. So, which is okay. But I just want to understand why you said no. Because I've taught you three things now for financial assets. Is either cash, investment in shares, or investment in debt, which gives contractual right to receive cash. So can that investment in plant give you a contractual right to receive cash? Bimi, you said no, so talk.
Assets are relatively liquid.
Sorry? It can be easily liquid. I didn't get you.
I was just thinking aloud that financial assets are relatively liquid instruments, while the plant is an intangible asset. Yeah.
So my own thought is if you invest in plants to use to produce slippers, the possibility that you might not make money from the slippers production too is there now. So can you really say that is a financial asset? Because I mean it's a form of investment still, but then is out of speculation because what if you don't receive cash from it?
Wow, that's intelligence. That's absolutely correct. So then that is the reason why most physical assets like real estate, properties, even intangible assets, maybe license, patent, franchise, plans that I've mentioned, they are not financial assets. Yes, you might make money from them. You might, and you might not. So those kind of assets, we call them PPE under IAS 16. And the definition there is that, or the recognition criteria is that it is probable that future economic benefit will flow. So it's not a guarantee, right? So those assets really gives you opportunity to create cash. They are different from financial assets. Financial assets, if it is cash you have your cash. If it is shares you have invested in, you might get dividend, fine, but you will get something, either in form of dividend majorly. And if you invest in debt, that person must pay you cash. That one is a must. He must pay you cash because it's very clear contractual right to receive cash. So fantastic, Bemi. Fantastic. Now, before I move on again, there's another one here. How about prepayments? Can prepayments be classified as a financial asset? So, what's the basic one I can have here? So, mostly if you paid for, let's say rent, let's just say rent. So, you paid for 1 year and you have really used it for 1 month. So, you still have 11 months to go. In accounts, we put that as that, okay, we are expecting future economic benefit, and now we are sure that we would get that benefit now because the guy cannot send us away because we have paid in advance already. Can that be a financial asset? So, class, what do you think?
I'm not sure I got your example.
Sorry?
I'm not sure I got your example. I didn't understand what you said.
The prepayment is to receive what?
So, you paid rent in advance. You paid rent in advance. You have only used it for 1 month. You still have 11 months to go. When you are preparing your books for that first month, you will recognize the portion of the rent you have not used as prepayment. So, can that be a financial asset? Or,
No.
le- or even a simpler one. You paid for a service that you have not gotten, then you're going to get later. Okay, so Aditya said no, that it cannot be.
No, it's not a financial asset.
Why?
No.
Why?
I can decide to opt out and say that I'm not staying in the place.
Uh-uh. You are not opting out. How do you want to opt? What kind of, why do you want to waste money?
No, because you've not paid for that service yet.
Okay, I think Aditya has answered it. Aditya have answered it. So you see, the answer is that if you look at the chat section, she said you are not receiving cash. You are just receiving service. And that's correct. Yes, you are not receiving cash. You must be, I mean, the third type of investment here now says a contractual right to receive cash. In this case now, what you want to receive is your service. So when the right to receive something is not cash, then it's not financial asset. It's another type of asset, not financial asset. Okay, I think we have done enough on this one. The second one is financial liability. That's the second one. So financial liability basically will arise when you have borrowed money or other commodities, when you have received something and you are expected to pay back cash. And the only definition I want you to remember, you can cram these other ones, right? Is it said a financial liability is any liability that is a contractual obligation to deliver cash. I mean, for practical purposes in this class, for your exam, if you understand this, you're free. Then you know what financial liability is. That what you must deliver is cash. If what you are delivering is cash, then you have a financial liability. But there must be a contractual obligation. You see, when we learned about liability in conceptual framework, we talked about legal obligation. So legal obligation, fine. That's what we mean by contractual. And there is the one of constructive obligation. That one is not contractual. That one does not give rise to financial liability at all. So constructive obligation is not a financial liability. So when you have things like provisions, provision is not a financial liability, right? Because there's no contract between you and anybody. So a financial liability, it's a contractual obligation to deliver cash. So you can cram these other ones if you want, but I won't really delve into it in this class. And just to be sure that you understand this point, so what's the reverse of prepayment now? If you, if a customer, if you collect money in advance, like for us now, I've collected school fees from most of you, right? And I'm supposed to teach it in the head of the diet. So accounting requires that I recognize some portion of that money as a liability because I've not actually worked for it. I've not done the work. So can that kind of liability be a financial liability? No, it cannot be a financial liability because what I want to deliver is service. I want to deliver service to you, not cash. Before I can recognize a liability as a financial liability, one, there must be a contract between me and you. Of course, there is a contract in this case. Secondly, is that I must be delivering cash. It's cash I must pay, nothing else.
If it is something else, that is not a financial liability. I hope you understand that emphasis. Another example or question to you, I'm going to ask this again. Tax liability, whether CIT, whether VAT, all these form of taxes that we have, can they be, or can we classify them as a financial liability? I want you to rethink it again.
Yes.
No.
Okay. So, for tax, you are delivering cash, right? That one is clear.
Yes.
Okay, but is there a contract between you and anyone? The tax you are
No.
paying, you actually enter into a contract with anyone,
No.
and then it is not a financial liability. It's not a financial, it's that simple, right? So
Though
it's
we're
not
delivering
just,
cash. Okay.
yeah, it's not just about delivering cash. There has to be a contract.
Yeah.
So taxes cannot be classified as a financial liability. So most of the things I'm saying, using to explain to you guys, I've actually written it here for you in the note, so you can still look at it. And the last element of that definition is equity. So the same definition we gave under conceptual framework: contract that evidences residual interest in the asset of an entity after deducting all its liabilities. My equity instrument is my shares. So in fact, before I can even have an equity, I must have a company. So my shares in my company, the shares in my company is equity. So equity is just ordinary shares. It's not more than that. So if you have your company, the share capital, your share capital, basically the ordinary share capital is your equity, because those guys that are residual interest. So that is equity instrument. It's not really more than that. Okay. So, and I gave some examples of financial instrument contracts here. I have credit sales. So when you sell on credit, it is a financial instrument contract, because the seller will have a trade receivable, which is right to receive cash. The buyer will have trade payables, which is financial liability, because there's an obligation to deliver cash. So credit sales is a financial instrument contract. Credit sales, not cash sales, though. Credit sales. Bank savings or all forms of bank deposits is a financial instrument contract. So if you deposit your money in the bank, you, the depositor, you have a financial asset, because you have a right to receive your money from the bank. The bank has a financial liability, because they have an obligation to deliver your money. So the same analogy goes for loan. When you borrow somebody money, goes for lease contracts, purchase of treasury bills, or even when you buy shares, right? When you buy shares this is the era where banks are issuing shares now, so you can easily relate. So if you buy those shares, you have an equity investment, you have a financial asset. The company that has issued the shares, they have an equity, not liability. I've simplified equity for you. Shares, if you have a company, your shares is your equity. So those companies that are issuing those shares, they have equity. Okay, so I'm done with introduction to financial assets. Just to be fully done, we have these questions for us to juggle our mind together. So financial instrument is a darling for ICANN. They like asking it, so you really need to understand it. And this part for me is the most important part. So when you get this one, then those other parts will be easy. I would like you all to participate. I don't want just few people to participate. So we're going to solve these questions together. There are 8 questions here, and that means 8 people will talk in this class today. 8 people. Except if somebody just refuse to talk, so that we won't waste our time. We'll just move on. We cannot really force anybody to talk, but we just hope they talk. So required. So what does this question want us to do? It said we should determine whether the item above are financial assets or financial liabilities, and also state whether a financial instrument exists. So, I mean, the company in question here is net worth. So you need to tell us whether net worth has a financial asset or financial liability, and you need to tell us whether a financial instrument even exists. And I want to know why. So let's start with the first one. So who is going to take the first one? Anyone?
Let me go. I'll start
Okay,
first.
Deborah. Okay, Deborah.
Yeah.
Let's go.
It's not a financial instrument.
Okay, net worth owns cash or financial or 5,000. It is not a financial instrument. Okay, I mean, let's start from what does net worth has? Does net worth has a financial asset, financial liability, or equity? Let's start from there first. So this cash, what is it to net worth?
It's an asset.
Is it a financial asset? Is it a financial liability? I mean, not just saying assets.
It's
He doesn't
not.
have a contract with anybody.
It's not a financial instrument because there is no contract. It just
Oh.
owns, like there's no contract between anybody, between him and someone. It's just what he has, basically. So there's no
Yeah, I agree with that.
contracts.
I agree with that. I agree with that. And you're correct. I agree. Yes, he just owns cash, no contract with anybody. But you need to tell me, I have to classify this cash some way. So can I classify cash as a financial asset? You need to answer that.
I would
So,
say we classify
or
as an asset. Hello, can you hear me?
yes, I can hear you.
First off, that is not even a financial instrument. I'll just say it is an asset because like cash is an asset basically. So I'll call it asset and not just a financial asset for me. I don't know.
Yes, so at your level now, you can't just say asset because it's either you have PPE, you have intangible assets, you have cash and cash equivalent, you have investment property, you have biological assets, you have financial assets. When you're preparing your account, you need to classify your items in either of these categories of asset. So you can't just say assets. So where do you classify cash?
Cash and cash equivalent.
Cash and cash equivalent. So good. So so that we'll save our time, right? You have made an attempt. You're actually correct. Correct in the sense that there is no financial instrument contract here. Because this guy just owns cash. He doesn't have contract with anybody here. Probably he has a physical cash in his office. Fine. But that's not the only part of the question. The question is 2 parts. You need to tell us, does this guy net worth has assets or liabilities? Has financial assets or financial liability? You need to tell us that. And you need to tell us whether financial instrument contract exists. So let's go back to the definition of financial assets. Let's go back. So IS-32 said that financial asset is any asset that is cash. So this is a financial asset. So net worth has a financial asset, right? So you classify cash and even cash equivalent as a financial asset. So the second part of this is that net worth does not, I mean, there is no financial instrument contract here because he only has a financial asset. There have to be at least two parties. In this case, no other party. So good job. Yeah, nice one. So let's go to the second one. Who will go for the second one?
I think for the second one, there's a financial asset, there's a financial liability, and there's a financial instrument.
Yeah, that's correct. That's correct. But you need to break it down. Who has financial assets? Who has financial liability?
Net worth has a financial asset. First Bank has a financial liability, and there's a
Fantastic.
financial instrument created.
Fantastic. That's correct. That's correct. So net worth owns the demand deposits. That is a financial asset. First Bank has a financial liability. Since those two sides are present, that means there is, of course, there's a contract. There has to be a contract. That means there is a financial instrument contract. Thank you very much. Who is going to go for the third one? Who is going for the third one?
Let me go again.
Yeah,
Yeah,
go
no.
again.
Okay. So there's the financial assets, and then there is equity, because the financial assets is from net worth, shares. It has equity in it has a share in Google Inc. Then Google Inc. is the has equity. I don't know. Then there's the financial instrument because it's
That's absolutely correct. Absolutely correct. So net worth invested in shares, equity instrument of another entity, and Google is the issuer of the shares. And I've told you, anytime you have shares, like if it's shares we are talking about, that is equity. Don't think it twice. Don't complicate it. That is equity. If what you're talking about is share capital, these are my share capital. I issued share capital. You have a company, the shares in that company is equity. You have a company, the shares in that company is equity. This is different from you buy shares. So if you buy shares, that's financial assets. So Deborah is absolutely correct. Net worth has a financial asset. They bought shares in Google. Google, the issuer, has equity instruments. Fantastic. Let's go to the fourth one. Who is going to go on that?
I'll go.
Yeah, go ahead.
Okay. This is not a financial instrument because inventory is a tangible asset, so it's not cash. It does not satisfy the criteria of a financial asset or liability.
Fantastic. You're absolutely correct. So, but you need to tell me, what does net worth has?
Net worth has inventory.
That's
Is
correct.
is an asset, but it's a tangible asset.
That's correct. Net worth has inventory, and according to IAS, true. So it's not a financial asset, but just an inventory. So apparently, there is no financial instrument contract here. Since there is no investor, so that means the other party cannot even exist. That's correct. Okay. The next one, who is going to go on that? If you have gone before, you can go again so that we will not waste our time. Some people have slept already. I know them, and I can see them sleeping. Who is going? Who is going?
The financial
Let me
assets, there's
try.
a financial liability,
Let me
and
go
there's an
again.
instrument.
Okay.
Okay, please go ahead.
Okay.
Okay. For net worth,
Go on,
it
Deborah,
is
it's okay.
sorry, I didn't hear that. For net worth, it is a financial asset because they have the right to receive cash. Then for Lai, it's going to be a financial liability because he has an obligation to pay 55,000 to net worth. So yes, it's a financial instrument.
There's a trade receivable, there's a trade payable, and there's a financial instrument.
That's correct. Absolutely correct. So net worth has a trade receivable, which is a financial asset. Lai has a trade payable, which is a financial liability. That means it's complete already. So there's a financial instrument contract. That's correct. The next one.
Okay, let me try.
Okay, go ahead.
Okay. Net worth is having a financial liability of 250,000, while Muri has a financial asset. Net worth has a contractual obligation to deliver goods worth 250,000 to Muri.
Okay, so again, I didn't get you. What does net worth have?
Financial liability.
Okay. How
While
about
Muri has a financial asset.
so that means there's a financial instrument contract.
Yes.
Okay.
But it's
That
to
is
deliver goods, not cash.
exactly. So that is
It's
not
goods, not cash.
exactly. So Jide, that's your answer will not fly.
Yes.
That your answer will not fly. Yes. Because what
Why?
movie wants to deliver, what this guy wants to deliver is goods. Okay, so
Yes, I said goods worth 250,000.
yes, I know now. So when you have an obligation to deliver goods, that cannot be a financial liability. It must be an obligation to deliver cash. So yes. Yeah. So it is not a financial liability. It's not a financial liability. So that's that. So there's no financial instrument contract here. It's just another form of liability, not a financial liability to deliver goods. So yeah. So net worth does not have a financial liability. Net worth has, maybe we'll just call it deferred income or something like that, or contractual obligation or contract liability. So the next one, we'll go for the next one. Who is going to go for the next one? Who is going to go for the next?
I recall what you clarified before we started going through these questions regarding tax liability, that there's no contract between the entity and government, so it does not qualify as a financial instrument.
Yep, that is correct. That is correct. So let's move to the next one. Net worth purchased the Bitcoin.
Okay, let me try.
Okay.
I think this is a financial instrument because this Bitcoin is in form of cash, something that can give one cash, and there is Okay, so but there's no other party.
No, there will be now.
Okay, there's that they are
You
purchasing
will
from.
have bought it from somebody.
Okay, so that means it satisfies the criteria of a financial instrument. So this should be a financial instrument.
Okay.
Or if you can't cash out. I don't know
But
cryptocurrency
for the
very well.
Bitcoin, is there like a contract for the purchase of it?
Yeah, there will be most purchases, the invoice you will get or any documentation represent a contract. Yeah, so the contract might not really be the issue here. And the issue we might have is what Robert is actually raising here now. That can he actually cash out? So, and the way Diamond is putting it, she's saying that Bitcoin is a form of cash. So, I mean, the key question here is net worth. Can net worth classify this Bitcoin as a financial asset? That's the key question here, and the answer is no. Bitcoin is not cash. Is not cash. And why can I say that authoritatively? Is in line with IAS 7, Statement of Cash Flows, right? IAS 7 defined cash as a means of payment that is generally acceptable and that has an insignificant risk of changes in value. That is how IAS 7 define cash. A means of payment that is generally acceptable. Bitcoin is not generally acceptable, so you cannot say it's cash. So you cannot say it's not a mode of payment. It's not generally acceptable. Yes, some people can accept it, but some people don't. If you bring Bitcoin to net worth, we will not accept it. Or you bring Bitcoin to equity, we will not accept it. And the risk, and before you can call something cash, it must have an insignificant risk of changes in value. It's not something that will just be changing in value like the way Bitcoin does. Today, the value will be $80,000 for one Bitcoin. In the next day is $60,000. 20,000 margin. The next day you could have been $90,000. That's huge risk of changes in value. That is not cash. A cash must be stable. I mean, it actually troubled me that one of you might even ask me a question and say that, Oga Wasiu, is Naira cash? I mean, I was thinking about that because the rate at is even changing. Yes, is worrisome. You see, the fact that the Naira is at 1,600, 1,700 to $1, or even over 2,000 to £1 is not the problem. It's not the problem. The problem is how volatile it has become. That is the key problem. CBN says that they're in the process of price discovery. How long do you want to discover price? Why would you just, they have placed the nation in a kind of uncertainty that investors cannot plan. Even for reporting purposes, it's difficult to classify it as cash. A cash must have an insignificant risk of changes in value. It's not something you expect to just be. It must be a store of value. But going back to what we're doing here, Bitcoin is not a financial asset. It is not cash, right? The only standard that defines cash is IAS 7. Bitcoin is not cash. And Bitcoin is not equity, which is the second component of the definition of a financial asset. And the third component of definition of financial asset is contractual right to receive cash. You see, when you buy Bitcoin, it doesn't give you right to receive cash. Never. Never. It's just you're just investing somewhere with the hope that the value will go up or go down. You'd it is not like a right to receive cash. When you need your cash, you would have to go and look for a buyer. You have to go and look for somebody that would buy it. You have to put a lot of effort. So when you say right to receive cash, you won't put effort. The person knows that he has an obligation. So you will just sit down. You just sit down and be waiting for the person to pay. You won't put effort. Your effort is your initial service you have rendered. Your effort is the initial cash you have borrowed out or lent out to someone. That is your effort. So when you say right to receive cash, it means you do nothing, absolutely nothing. Money will just be flowing in. So here, Bitcoin is not a financial asset and there's no financial instrument contract here. And that is it for this one. I know you will not ask me, but I will ask you. If I am saying that Bitcoin is not a financial asset, that network cannot classify this Bitcoin as a financial asset, then how can it classify it? What type of asset or what category of assets or class of assets will Bitcoin be? We need to classify it some way because people actually buy it. It exists. It's a transaction that exists. So if you work for a company that now buys Bitcoin, so how do you then classify it in the statement of financial position? What type of asset do you think it can be? So it's either PPE, inventory, intangible assets. Yeah, Ayo, correct.
Intangible.
Yeah, that's correct. Absolutely correct. It's an intangible asset. It doesn't have physical substance. Yeah, it is an intangible asset. That's correct. However, it can also be inventory to those guys that are selling it. So if I have an exchange and my job is that I want to be selling Bitcoin to people, I would classify that Bitcoin as an inventory in my books. Okay? Okay. All right. So we are done with part 1 of this class. So we are going to part 2. This class is segmented into 3 parts. So part 1 is this one that we have done, which is the most important part. And from all indications, it seems you followed well. So the part 2 is this one. And recognition, derecognition, and measurement is actually governed by IFRS 9. So IFRS 9 deals with all of that. So when you have identified that you have a financial instrument contract, it exists. And of course, you know which of them you are having. Is either you have a financial asset, financial liability, or you have equity instruments. You need to be able to classify it some way, somehow. And whether you would have any of the 3. So when can you recognize it in your books? So you can recognize whether financial asset or financial liability in your books when you become a party to the contract. That is the recognition criteria for financial assets. As soon as you become a party to the contract, then go ahead and recognize it in your books immediately. So that is the recognition criteria for a financial instrument. So whether it's a financial liability you have, a financial asset you have, as soon as you become a party to that contract. And you see, you can become a party either at the date you signed an agreement or at the date where you made a commitment, you become a party. But that is the basis for recognition of financial instruments in the financial statements. Now, the next one here is derecognition. Now, when we say derecognition, we are talking about removal. So, derecognition of financial assets. I'm going to take this one by one because the recognition of financial asset is different from the recognition of financial liability. And why? Before you can even include financial assets, the basis is that is either cash or you have bought shares or you have a right to receive cash. That one is different from, so when you want to remove it from your books, there are two criteria, right? Number one is that your right to receive cash now, it has expired. Or you see that shares that you bought now, you have sold it. So he said the entity has transferred substantial risk and reward of ownership of the financial asset to another entity. So majorly this one is speaking to shares, and it could be debt instrument that you have bought also. You can sell that too. So, but for simplicity and easy understanding, let me take this as when you sold or when you sell your shares, that means you have transferred the risk and reward of ownership. And that's what I've actually explained here. An unconditional sale of the financial asset. That means an unconditional sale. What if it's conditional? And which is the second one. So there are some sale that comes with condition that, okay, well, I'm selling these shares to you, but I will buy it later. I will buy it later if it's at fair value, then that is sale. But if you are the one specifying the price at which you buy it later, IFRS 15 will tell you that that one is not sale. You cannot be dictating, that means you have not actually sold. So if it is conditional, right? But for me, I would just want you to know this first one, an unconditional sale of a financial asset. Okay, but have it in mind that there are some sales that could be conditional. Now you could sell your shares to somebody and you'd agree with the person that, okay, I will buy it back, whatever the price is. Whenever I'm buying it, I will buy it back. That one too is sale, but it's conditional. It's okay. You have sold, right? So here now, you can recognize financial assets under these two criteria. You have to know this because the examiner will ask you, you will see when we start solving past questions. I will show you how I can ask these things. So these principles are very, very, very important. So now, for financial liability, for financial liability, it can be derecognized when it is extinguished. When it is extinguished, then derecognize it. And when we say extinguished, we mean that the obligation in the contract has been discharged or cancelled or expires. It has been discharged, it has been cancelled or expired. Then that's extinguished. And it's by simplicity, it means that you have settled that liability. You have paid the person the obligation you are owing. But it's always more than that. Okay, so the fact that you have paid the person means it is discharged, right? And in some other instance, it could be cancelled. And in some other instance, it could have expired, depending on the arrangement, right? So that's extinguished. However, there are some complex parts which I've not really seen I can ask about the recognition. The recognition is a very complex part of financial liability. Very, very complex, right? So majorly the one I've seen I can ask is the one this one I've explained is everything I can would really ask you in the exam. But let me just give you a snapshot of some other areas, like the recognition of or removal of financial liability can arise from exchange of one instrument with another, right? So when you exchange one instrument with another, maybe you borrowed company A money, right? So there's another person too that borrows somebody money. You people can exchange. So that means you'll be dealing with different parties now that will settle you because you are dealing with another instrument. So exchange. So when there is exchange, that means you are going to derecognize the one you had before. You derecognize it and you recognize a new one. And also the recognition can arise when there is a substantial modification of the terms of a liability. So if you owe money, if you borrowed, I say borrowed. Yeah, of course. If you borrowed money and you're expecting to pay, you're supposed to pay, you're supposed to settle, and you could negotiate modification of the terms of that liability. Maybe you want to tell them to adjust your interest rates, they should reduce it, or maybe they should give you more time, extend the period, and different terms that could be modified. So if the modification is substantial, we could see that as removal or the recognition of the original contract. So, and when we say substantial, that means that by the time you work out the changes in cash flow, as a result of that modification, that change will be at least 10%. I won't go into these details, right? So that I won't just for the sanity of this exam. And so if the change as a result of this modification is substantial when the difference in the cash flows is 10%, then that means you have to recognize that original one and recognize the new one with the new terms. And of course, when you have derecognized a financial liability, you have to recognize either a profit or loss, depending on whether the settlement price is different from the book value or the carrying amount. You add it in your books. So if they are different, then there would be either profits or loss on the recognition. So that is it about recognition and derecognition. Any questions? Any questions? Okay, since you won't ask me question, what I expected you to ask me is that when I was explaining financial instruments, there are three elements. I explained financial assets, I explained financial liability, and there is equity. So I mentioned the recognition of financial assets. I mentioned the recognition of financial liability. I did not mention the recognition of equity, and nobody said anything. So that means you know. So how do you recognize financial or equity? So you see, the reason why we didn't mention equity here is that I've told you when we say equity, for somebody to have equity, you have to be a company with shares. That your shares is your equity. And it's not something you joke around with like that. It's not something you adjust. So every company law in every country have their rules for their own equity. In Nigeria now, the new CAMA 2020, even the old ones say frowns at capital reduction. we don't want capital reduction. You can buy shares back from people, from your shareholders. You can do share buyback, but you cannot derecognize share capital. That's the end of the business now. When you derecognize, you remove share capital. That means you have removed the owners. So we don't derecognize share capital in Nigeria. You have to continue. You must continue. Nobody is closing. So except if you say, okay, we don't want to do business again. We want to liquidate for reasons beyond your control, then fine, you can go and liquidate. But don't come and say you want to recognize your capital. No, it is not allowed. Even capital reduction is not allowed according to CAMA. So that is why this standard did not mention the recognition of equity instrument. Yeah. So measurement. I know you're tired, but I just want you to stay with me. Just try for like 10, 15 minutes. I will leave you guys, but I need you to stay with me. Just try and understand this one. I mean, immediately understand this one. It's fine, but it's very tricky. Okay, so for measurement now, there are three of them we'll look at: financial assets, financial liability, and equity. So let me quickly deal with equity first. So I've told you, when you have equity, that means you have a company. So the shares in that company is your equity. So the way we measure equity in Nigeria, so is not actually explained in the standard. So in Nigeria, equity is measured at nominal value. So whenever you see share capital, it must be measured at nominal value. And when I say nominal value, you would only find it in your form, your CAC form. When you're registering a company, CAC will have asked you the number of shares you want to issue and the nominal value. Most people just put a random value. Yeah, there's nothing wrong with putting a random value, but be careful, because it becomes problematic for you if you put something unreasonable, because that will be your share capital. That is what you would present as the value of your share capital in the account. So eventually, of course, nominal value could be 1 naira, could be 2 naira, could be 5 naira, whatever it is, whatever you want the value of a share capital to look like, that is your nominal value. And of course, whatever the amount you now resort to, you must be ready to inject that into the business. Majorly, that will be the number of shares you want to issue, and the value you are ready to put into the business will ultimately dictate your nominal value. Of course, the issue price, you eventually issue it to other shareholders, might be different. So you now find a situation where there will now be excess money available, which you will put in a reserve called share premium. Share premium. But the core thing here is that share capital is measured at nominal value. I won't say more than that. That is it for equity. For financial assets, don't forget, please. Financial asset is cash, investment in equity, investment in debt. That is a financial asset. So I'm going to deal with those one individually. So when you want to measure financial assets, the first question you would ask is that, okay, what financial asset do you have? Knowing fully well that it cannot be more than those three, at least for your exam at this level: cash, equity, that means investment in equity, you bought shares, or you have a contractual right to receive cash. You lend somebody money, or you provided goods or services to somebody and you're expecting money. It cannot be more than those three. So if the financial asset happen to be cash, how do you measure cash? Cash is cash. There is no other way to measure it apart from cash. Cash is cash. The money you have, put it in your books at that value. Cash. So no story around that. The second one is investment in equity. That is, it's also a financial asset too. So let me deal with equity first, then I'll go and deal with debt, investment in debt, when you lend somebody money, right? So for equity is when you buy shares. Okay, so how do you measure that? So the first thing I need to tell you is that, which I think you should know, that for measurement, there is always initial measurement. So, and which I wrote here, that all financial assets are initially measured at the transaction price, which is the amount that was invested. That's how much you put it in your books when you bought the shares, the money you paid. Put that in your books as a value. We call that transaction price, the money you invested. That's one. So now for shares now, I mean, what you'll have entered in your books will be, you probably credit bank and you will debit financial assets, but you need to be specific. You probably will call it investment in shares or investment in equity. So, but ultimately, it's called financial assets. But when it comes to shares, we need more explanation. We need to give our user more information. We can't just say, okay, we invest in shares. That is not enough, because there are different reasons why people buy shares, majorly two. Some people buy it just for short term or for trading. They just want to keep their money. Next month, they know they are selling. Why some people buy it for the long term? Some people buy it for the long term, like they have an eyes on becoming, they want to be on the board of this company. In fact, people that don't want to be on the board, some people buy shares for their children. That, okay, this shares is for my children. When you guys are 15 or 16, then you can liquidate and do with it as you please, right? Or even much older. So we need to know, because it helps users to make better decisions when we know that. So for that reason, that financial assets or that investment in equity, we say that if your intention is that you want to hold it for the short term, then you need to classify it. And this classification is done at the date of acquisition, the date you bought it. So you, as an accountant, if somebody tells you or brings a share certificate to you that our company bought shares, you need to immediately know that, okay, are we buying this thing for the long term or for trading? So if it is for the short term, which is for trading, you have to classify it at fair value through P or L. So usually, by the time you credit bank, the account you would debit, you call it financial assets. But you don't just call it financial assets, you will call it financial assets at fair value through P and L. So most of you that work in bank, or some of you that might be an auditor, you might have come across terms like this before. That is what it means. So when you see financial assets or any financial instrument at fair value through P&L, but in this case, it has to be equity, right? Shares. The company bought shares. So if it is at fair value through P&L, that means they are holding it for trading. It's not for the long time. They can sell it anytime. So, and if the intention is to hold it for the long term, you will call it financial asset at fair value through other comprehensive income. So now it is clear. So if I'm looking at your financial statement now and I see that you bought shares in Guinness, and I see that you classify it at fair value through OCI, I was okay. That means this company doesn't plan selling. And you cannot change. You cannot come next week and say, now we want to sell. No, that's a change in policy. It's major. it's really major. So it's not something you choose fair value through OCI today. You will now say you want to change it. No, at all. It's not allowed. So you have to think it through and decide which one you want to classify it. So, I mean, for our class today, what you're learning now is that when you buy shares, right, you must immediately determine whether you are buying it for the short term or the long term, because that would dictate how you're going to classify the account or you're going to describe the account in your books. So it's either financial asset at fair value through POL or at fair value through OCI. Okay. Now, then the next one is, how do you then measure it at the end of the year? So which is where we are. So at the end of the year, the same way you have classified it is exactly how you are going to measure it. The same way you have classified it is exactly how you're going to measure it. So you're going to measure it at fair value through POL or at fair value through OCI. At fair value through POL or at fair value through OCI. And what is the difference? The difference is that, you see, when you buy shares and you measure it at fair value through POL, share prices changes. It goes up and down, right? It's fair value, so it changes, it goes up and down. So those changes in fair value, those changes in price, if the way you have chosen to measure it is at fair value through P&L, that means those changes in fair value, you recognize it to P&L. If the way you have chosen to measure it is fair value through OCI, that means those changes in fair value, you recognize it to OCI. However, note that the way you classify it at the beginning, if you had classified it at fair value through P&L, it means you must measure it at fair value through P&L. If you had classified at the beginning at fair value through OCI, it means you must measure it at fair value through OCI. That one must be taken in first. And secondly is, what's now the difference between measuring at fair value through P&L and fair value through OCI? Is actually where you would recognize the changes in fair value. Is either to P&L or to OCI. Is either to P&L or to OCI. Okay, any questions? That is, I'm still on financial assets anyway, don't forget. And I'm on equity. Are we still here?
Yes, sir.
Yes.
Okay. Am I safe to continue?
Yeah, question, sir.
Okay, yeah, ask.
Yes.
Yes, today is Friday.
Yeah. Like me, I have class tomorrow now. Yeah, Mr. Jide, continue.
Okay. Yeah, I'm looking at the first one that says if I'm holding the shares for the short term. I was thinking if the short term would be within the year. So, but now that I saw the measurements, that at the end of the year, I have to measure it the same way I have classified it. So I now want to ask, is there a duration? The short term, it's more than a year now. Does it have a specific time? Like say 2 to 3 years, if I'm saying, okay, I'm holding it for short time, unlike the one I'm holding for a longer time.
See, long term means you won't sell it.
Okay.
Yes, you won't sell it. You are going to be with the company till they die. That's what we mean by long term. Yes.
Okay.
So if you have it in mind that I will still sell this thing, that's short term.
Okay.
So, I mean, the question I was expecting that you're going to ask me is that, okay, practically in real life, you are the accountant, your company bought shares. What the guy will tell you, I don't know. You cannot be asking the MD or whoever, that Oga, what's our intention for buying these shares? You cannot be asking somebody that. And if you can ask, fine, but in most cases, you'll find out that you cannot even ask. That means the standard say that you should assume is for the short term. If you are faced, I mean, the default classification is short term. And that's what, in fact, now with these shares that are out for banks, most people now that are buying, you find out that when it's time to pay school fees, they'll start selling. So, I mean, I don't know. Let's see how it goes. So that's that for investments in equity under financial asset. So let's round up financial asset with investment in debt when you lend somebody money. So the key thing around investing in debt is that you most likely get interest. And of course, you get back your capital. So you get interest and you're sure you're going to get back your capital. So, and that would dictate how we would account for it. So, of course, when you lend somebody money, initially accounting for it is also at transaction price. It's quite straightforward. So if you borrow somebody, if you lend somebody 20,000, just debit investments in debt, credit bank with 20,000. Is straightforward. So, but beyond that now, when you borrow people money, there are a lot of intentions to it, right? At a very basic level, we need to understand your intention. And for here, we actually call it your business model for managing the financial assets. What I'm talking about when I say business model, I'm actually talking about, okay, what's your intention? Why did you buy it? Right? Of course, you want to make money, but how do you intend to make money here? That's your business model. How do you intend to make money? And for debt investments, there are two ways you can make money. Number one, either you collect interest and principal. Okay, this one you will always collect. You should always collect, all things being equal. When you lend somebody money, you get interest, you get back your principal. So it's a constant factor there. So that's one. Number two, since of course you always collect interest and principal, that one will not shake, right? But of course, you could also decide that okay, you want to sell. You might want to see, you might have intention of selling. So for us here now, when you lend somebody money, in accounting for it, for you to account for it, you must think through this. At the date when you want to recognize it in your books, you must think through it that, okay, how do we want to make money from this thing? Is it just to collect interest for, if the period of the loan is 5 years, is it just that, okay, we want to collect interest for 5 years, then we get back our principal? Or do we have further intention that, okay, in addition to collecting interest, do you have plans of probably selling it in between, like that? So is either of those two, collecting interest, or in addition to collecting interest, you can also sell. So those two. And so aside those two, the second thinking process, aside the business model that you need to identify, you need to also identify that there is actually a contract. We call it contractual cash flow characteristics of that investment. Is there actually a contract that specifies collection of interest and principal? So is there a contract that specifies collection of principal and interest? And in most, for it to even be a financial instrument, there has to be a contract. So you find out that mostly this second part will be met. So an ICANN will not even focus on this one at all. What ICANN would want to test you on is this business model thing. They'll give you scenarios and be sure that you would know how to properly classify based on these criteria. They will not, nobody cares about this one because it's constant. There's always a contract that will say that, okay, you collect this interest too. This is when you collect back your money. That one is just there. It's a constant factor. Okay, so with this basis, this is the basis of classification, looking at the business model and existence of a contract, right? So with this basis now, you see, we can either classify debts, your investment in debts at amortized costs, at fair value through OCI, at fair value through P&L. So what would dictate the classification? So let me deal with amortized cost first, right? So you can classify debt as amortized cost if the business model is that it's just to collect interest and principal. If it's to collect interest and principal, that is this first one here. You know, is either this collect interest and principal, or in addition to collecting principal and interest, you can also sell. But for you to classify at amortized cost, that means you don't have intention of selling. That means you want to just collect interest, and at maturity, you collect back your principal, you collect back your money. That is for investments in debt. Not only that, there is this other criteria, which I told you is constant. There must be a contract that will specify that, okay, this is the interest you collect, this is the principal you collect, and all of that. So it's constant. It's always there. There has to be a contract. But the focus of the exam will be on this business model. You need to understand that before you can classify an investment in debt or a financial asset relating to debt at amortized costs, your business model is that you want to collect interest and receive your principal at maturity. That is your business model, and that's the most important thing here. That's amortized cost. You see, for fair value through OCI, okay, I saw some questions here. Let me go to fair value through OCI. For fair value through OCI, right? That one, your business model is the second one, which is to collect interest and principal. I called it to collect contractual cash flows, which is interest and principal, and also to sell. So your business model is to collect interest and principal, and not only that, you can also sell. So if you have opportunity for higher yield, I mean, you borrow somebody money and the person is giving you 8%. You know that as soon as you get somebody that can give you 11%, you would sell that financial asset to another person, collect your money, go and borrow another person that will give you 8% or more, or 11%, as the case may be. So the main thing for us here for your exam is to look out for, they will give you a scenario that, okay, this guy can also sell. As soon as they mention that, he can also sell this financial asset, know that you would have to classify it at fair value through OCI. And the final one is fair value through P&L. So this one is also a default classification. Is a default classification. So if you cannot classify it at fair value through OCI or amortized cost, then you should classify it at fair value through P&L. In fact, when you invest in debt, you borrow some of the money, the default classification is fair value through P&L. That's the default. So that one, no thinking is required. You don't have to think about business model, whatever. It's fair value through P&L. But when you want to really think it through, then you would be going for business amortized cost if your business model is just to collect interest and principal, or you are going for fair value through P&L if your business model is that in addition to collecting interest and principal, you can also sell. Then fine, no problem. So that's all I've dealt with now is classification. Now, the measurements is just the same way you have classified it is exactly how you're going to measure it. So when you have a debt instrument, they are also measured at amortized cost, fair value through OCI, and fair value through P&L. So just that fair value through OCI, fair value through P&L is actually straightforward because it's just fair value. So we expect that they will give us fair value. But for amortized costs, I'll have to teach you how that is determined. I would have to teach you how that is determined. But before I teach you that, let me quickly tell you that for financial liability also, that one is majorly measured and classified at amortized cost. For financial liability is majorly classified at and even measured at the end of the year at amortized cost. Okay, so that is really it for measurement of financial instruments. For financial assets, we have looked at if it is equity, you classify it at fair value through P&L if your intention is to hold it for the short term, and you classified it at fair value through OCI if your intention is to hold it for the long term. And the way you have classified it is exactly how you're going to measure it at the end of the year. However, if your financial asset is debt, then you will be looking at amortized costs, fair value through OCI, fair value through P&L. And the basis of this classification, you said it depends on your business model and your contractual cash flow characteristics. And business model is either just to collect interest and principal, or in addition to collecting interest and principal, you're also going to sell if you have opportunity to. So for amortized cost, your business model is that you just want to collect interest and principal. For fair value through OCI, that one is just that you want to collect interest and principal and also to sell. And fair value through P&L is default. It's default. So that one doesn't have any criteria. You can just decide that this debt investment, I want to classify it at fair value through P&L. And the same way you have classified is how you would measure at the end of the year. Okay, that's for financial asset. For financial liability, of course, that one is classified at amortized cost. It's classified as amortized cost. So, and that is that for measurement. Now, what is left here now is for me to teach you how to get these values, especially for debt instruments, especially for that amortized costs. I just need to show you. I'm not going to show you tonight. I would like to start my class with that, so you typically understand that very well. So I would stop my class here for today. So next week, I will teach you amortized costs majorly. So I'll quickly run through that. It won't even take me 10-15 minutes to quickly. Of course, I will revise, then teach you amortized cost. Then we can then go to, we'll solve some questions here, but you are the one that will solve the major part of it because they are very simple questions. Then I will go to convertible instrument next week. This one ideally should not even take us 30 minutes as well, because of the understanding you have in share-based payments. Then I will show you some past questions. ICANN has really asked it severally. I think it was there last night. I will check it. Then next week, I will also look at impairment of financial assets. I think this is where I would, if you finish this up next week, then I will probably stop here. Then that means upper week, we'll just start with IFRS 13. It's not much. IFRS 13, then go to IAS 21. I think we are moving at a good pace in this class. And on, we'll just continue to kick the standards one by one. So go and read, just try and revise. I know you guys are very busy. And for those of you doing more than one course, I'm sure most of our lecturers are hassling you with series of assignments. Even my own assignment too. Yeah, some of you submitted, which is very good. And you just have to look for time. That's just the thing. To be solving questions, especially those assignments we are giving you. Like I've sent 2 questions on share-based payment now. And I sent one yesterday, another one. And some of you might have not even done the first one. And that one, I've not shared the solution on the platform, but I've shared the solution with the people that sent the solution to me that solved it. So I think you should try it so that you can get the solution. The second one too, I've shared it because those assignments goes a little bit beyond what I taught you in class. Yes, because you'll be seeing some new things there and it will expose you to some further things. I'll release a video on the solution also, not just text solution like I promised. I will do a video so that I can explain those further things to you and you go advanced. So the same way, I will be sending in assignments on IAS 19. Since we are done with that, at least I will be sending like 2 questions, like two questions to you for you to practice, and so that would also help you. Then when I'm done with financial instrument, I will also send further questions on that as well. So do we have any question? I guess we'll see next week Friday. Thank you very much. Have a wonderful night.